I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, we discussed a trade idea today in one of our classes, our group coaching class, and the trade was in Baidu. Take a look at a chart of Baidu. Now, since last November, this stock has been in somewhat of a downward sloping trend, and we can draw a trend line that forms a resistance level. Now, there's even stronger resistance up at the $176 a share level. Now, to me, when I look at that, I start thinking, well, hey, there's kind of a ceiling here. There's a better chance of the stock going down rather than up, and there's a really good chance that the stock is not going up above 176 or any higher than that. So the next thing I do is I look at implied volatility. So the implied volatility in Baidu is actually somewhat elevated, making the options expensive. Now, this, of course, sets up the perfect storm for a call credit spread. Specifically, what I like is selling the September 180 calls and at the same time buying the September 185 calls to establish the 180-185 call credit spread in September. Now, right about now, I could sell that spread for about 65 cents or better. Now, I think that that's a great price. It's a high probability trade. I think I have a great chance of winning, and I'm selling something that's arguably overpriced. Now, notice that the resistance level is at $176 a share, but I'm selling the 180 strike calls. That gives me an extra whole $4 of what I like to refer to as sort of wiggle room, so that even if we do go through resistance, which I feel is unlikely, if it goes through just a little bit, I'm still okay on this trade and I can still have a winner. Now, here's the breakdown of how this trade works. As long as Baidu stays below $180 a share between now and regular September expiration, which is not all that far off, the trade's a winner. I get to keep the premium that I collected when I put on this credit spread. Now, if, however, I'm wrong and Baidu does indeed break out above 180, well, that's when I can do one of two things. I can either close the trade, maybe take a small loser before it becomes a big loser, in which case small loss potential and a bigger profit potential is fantastic. That's exactly the way you want to do it, especially on a high probability trade like this. Or, of course, I can roll. I can roll up and take off the 180-185 spread and put on the 185-190 spread, giving myself an extra $5 of wiggle room. This is one of the techniques we teach to our students all the time in our group coaching class and many others. This is Dan Passarelli here on the floor of the CME Group for MarketTaker.com. Trade smart and have a great rest of your week.